All right. Well, thanks everybody for being here tonight. And this is our house hunting and hacking group that we meet on the second and fourth Tuesdays of every month. And this is the fourth Tuesday. So please feel free to join us. You can find us on Meetup, where we post all of our meetings calendar. And you can join us. We do try to post our topics 2 weeks in advance, so you can decide if that's something you want to attend. Or even come with questions prepared if you like. And then this is our group of admins for the group. Myself, Genevieve Henderson, and then John Nichols is our realtor. And I'm going to have him be our moderator this evening. And Amber Zamudia, who is not able to attend this evening, but she is our insurance specialist. And tonight's topic is down payment assistance. The what, when, where, and who. I am the presenter, Genevieve Henderson, and my moderator is going to be my buddy John. So we're going to switch gears here, and I'm going to stop sharing for a second. And then we're going to switch to the PowerPoint that we need for this next segment. Let's see. It's a bit tricky when there's two screens. Stop sharing, and now I'm going to go back to this PowerPoint. A slideshow from the beginning. Let me share. I don't know what's happening here. Hold on just a second. Not cooperating. Hopefully not. All right, y'all all able to see it?
Yep.
So
Yes.
we're all good?
Yes, I can see it.
So down payment assistance, also known as DPA. So I'm going to use that abbreviation a lot throughout this presentation. My job title, just an introduction of who I am. I'm a senior mortgage loan officer with American Pacific Mortgage. And my history background is I attended the University of Texas at Dallas and have a Bachelor of Science in Business Administration. I also worked as a paralegal in various legal fields for over 8 years, and I'm a licensed mortgage loan officer for 5.5 years. But I guess I'll need to be updating that soon because I think we're about to get to 6. So, all right. So what down payment is not? Down payment is not a first-time homebuyer program. I consider first-time homebuyer programs to be a different type of thing, and down payment assistance to be down payment assistance. So not all first-time homebuyer programs include down payment assistance. Down payment can sometimes be extended to people who are not first-time homebuyers. So there's another important point. First-time homebuyer programs do not provide down payment assistance in and of themselves. First-time homebuyer programs usually provide advantages to homebuyers with reduced rates and pricing and discounted mortgage insurance. First-time homebuyers are generally defined as homebuyers that have not held title or been on a mortgage for the last 3 years. So if you meet that definition, you are a first-time homebuyer and are eligible generally for those benefits of first-time homebuyer programs. Down payment assistance programs in Colorado. The first one, APM, my company's 1% down program that actually rolled out literally yesterday. So I literally had to go in and change this whole PowerPoint to make sure I included that and research the heck out of the program so I knew how to talk about it. The others are Chaffa, Lakeview, Land Home, and Metro DPA. This is that new one that just rolled out from my company. So you can see some of the specs here. It's conventional financing, minimum credit score of 620, purchase of primary only, but that's kind of typical of the DPAs. Lender grant of up to $4,500. And that's where I started to question how beneficial this was actually going to be. As a program I'd, be using a lot. So I ran the numbers on that because it's up to, typically you have to have at least 3% down. 3% down for a minimum for a conventional as a first-time home buyer. So the company comes in with 2% or $4,500, whichever is less. So typically, if you do reverse calculate $4,500, that means your loan amount would be $225,000. And that doesn't buy you a whole lot in Colorado. So, so I didn't see this as being a down payment program that I would actually be using compared to the other ones that I use. It's available for first time and repeat home buyers though. And it's a grant. So that's the other beauty of it. There's not going to be payments on this. You don't have to worry about paying it back. And there's also no fees on it. So there are other down payment assistance programs have fees. It's also available in all states except New York. So it could be used in Florida as well. Maximum loan amount is $275,000. So that's the maximum loan amount that's allowed on this program. But like I said, if you reverse calculate and trying to really get 2%, you're looking at a loan amount of $225,000. And that there are income limits that apply. So here's my world of lending of the different down payment assistance programs that I have analyzed with pros and cons. And the first one is the one we just talked about. So I kind of reiterated a lot of these things that we just went over on the pretty page that was before this. And the convention only, so I see that as a con, is that it's only for conventional loans. And the income limits I consider to be low at 80% area median income with higher, I also believe it has higher interest rates than the Chaffa program. And it has a 1% down minimum from borrowers. And I feel like I've got other down payment assistance programs that don't require 1% necessarily. So I kind of see that as being a con of the program. So Chaffa. Chaffa is, as you can just kind of like see on this chart, compared to the others in general, when you look at the bullet points, they've got more pros than they have cons in general compared to any of the other programs. And this is why I end up using Chaffa the most, but here we go. So Chaffa is very similar and that has a FICO of 620 minimum. It has the pro of being able to do conventional, FHA, VA, and USDA. So a lot of versatility in being able to meet clients' needs. There is a second lien, so this is not forgivable. They have different programs where you can do a grant, but it does carry the highest interest rate. But generally the program I use from Chaffa is a second lien, but the rate is 0. So it's free money in the sense that it's 0 interest. It just sits there. They have also lower mortgage insurance coverage and rates. So that can help people qualify for more home, more price. They also have options of 0 down payment. Like you can literally use this program just to get a better interest rate with what's offered. They also have 3% and 4%, and they have no monthly payments involved with that second lien. Their minimum down is $1,000. And we actually closed on one in that scenario about less than 30 days ago, where we had so much in seller's credits that the client literally got into the house for $1,000 and some change. So this is that kind of market right now to be able to negotiate, because buyers are leaving the market because they can't qualify or they just don't feel comfortable with the rates. So if you can get in, and you can get some amazing seller credits and really good deals in negotiation. Home buyer education is required for this DPA, and the income limits vary, can be anywhere from low to a fairly moderate area median income type scenario. So I like that. And then some products require first-time home buyers, but many do not. So that's why I end up using Chafa a lot. Lakeview has some pros as well. They do 4% DPA, which is kind of similar to Chafa. It can be used for down payment or closing costs. No first-time home buyer requirement on their product. The income limits are also moderate. Their minimum FICO though is 660, and they're conventional only. So you're starting to see these cons kind of stack up. The second lien rate is same as the first lien rate. There's another con. Second lien payments are interest only, and they go against the DTI. Another reason why I don't use this program. Homebuyer education is also required, and I find that it also has higher mortgage insurance coverage and rates as compared to like with Chafa, where it has a discount. Land home is another one. There is no minimum down, so that's a pro. It's in all states except New York and Washington. Homebuyer education is required for credit below 660. Their minimum FICO is 640. So it's a little higher than the other two at the top. Homebuyer education, 3.5% DPA. So it's FHA only, and that's why that is a 3.5% DPA. The closing costs are not covered. So the 3.5% is what they're fully covering. They're fully covering the down payment, but they're not going to cover any of the closing costs. And the closing costs are going to increase because of the DPA program. There's no first-time homebuyer requirement, and the income limits are high at 160% area median income. The cons would be they have condo overlays, the FHA we already talked about, FICO. It's a 15-year fully amortized second lien is what that DPA is, with a rate at 2% higher than the first lien rate. And the second lien payments go against the DTI. So again, that's why I don't really use that program. And then the last one is Metro DPA. They have no minimum down. They can also, just like Chafa, they do the full spectrum of agency loans. No first-time homebuyer requirement. Second lien is forgiven over a prorated 3 years. So you can actually refi in like a year, and you would still only owe 2 years back of the DPA that you borrowed. They've got 0, 2, 3, or 4% DPA. You can pick and choose what you need. The income limits are high at $188,250, and there's no monthly payments involved that would, hit against your DTI, your debt to income ratio. The minimum FICO score is 640, and it's limited though to approved cities and counties in Colorado. So that's where it gets really tricky. If you're not like within the highways of Denver, I really gotta like check and make sure the city that you're shopping in, or the county, or maybe you're on the outskirts, that it actually qualifies for this. Otherwise, we're like scrambling, looking for developing another whole loan scenario plan. The homebuyer education is required. It does have higher rates than Chafa, which is also why I don't use Metro DPA. And the DTI ceilings are more restrictive for lower FICO scores. So if you've got less than a 680, you're limited to 45% DTI. And the FHA score, if it's less if it's greater than 680, you're limited to 45. No, if it's less than 680, you're limited to a 45% DTI. If you got greater than 680, you're going to be limited to a 15 DTI. Now I'm telling you with Chaffa, this scenario is different in that the dividing line is at 660. So it's a 20% score lower threshold. And instead of it being 45 and 50, you're looking at 50 and 55 DTI. So again, so many, in my opinion, so many benefits and fewer cons with Chaffa, that's why I have been doing Chaffa all day and all night. So does anybody have any questions? Because I know this slide has a lot of info.
That is a lot to absorb. It's one of those things where it's good to look at, but obviously we rely on you to find the best one.
Yeah, probably explains a lot of my why I might come across as stressed out at times.
Yeah.
Analyzing all this information, trying to figure out
Would
which
you
one makes
say,
sense.
yeah, sorry to interrupt, but would you say that each one fits a certain niche, or why are there 5 of them?
Well, definitely with the differentiation of traditional versus FHA. So anybody that I've got that's below 700s, I typically take towards FHA because they get penalized so much with conventional that they're just not a conventional borrower. They're an FHA borrower. And so that makes a big dividing line, right? Because we'd be taking out at least 2 programs with conventional right there. And then too, if I ever get the client that needs to do USDA, I've only got 2 options there. And then typically also the fact that we've got credit score different thresholds of credit scores here. A lot of times I'm doing good to get somebody into that 620 range. And that's only doable with 2 of those programs. So it's almost like, you know, almost in many different scenarios, you've only really got 2 options for someone. And then at the end of the day, you're going to go with the one that can get them the best rate and get them qualified for the highest price, which generally tends to follow the best rate.
So real quickly, I didn't quite understand the 1% one. So the maximum loan amount is 275. I think there would definitely be ways to find people and like condos, like 1 bedroom, 1 bath, 2 bedroom, 1 bath, maybe a 2-2, depending on where we are. So I think it's doable, but remind me again, like, how do you recoup? How do you end up only paying 1% and being able to get a loan at 275?
So in a scenario of if you have a 275 as a loan amount would be reverse calculated at a price of 283,505.
Okay.
I did that math. I was like, this is probably not going to be something I'm going to use in Colorado. I mean,
I would definitely say there's potential.
you
But
could
then of course, you got to factor in things like the HOA and such too, right?
well, luckily it'd be conventional, so that wouldn't hopefully be as big of a deal if you're needing to finance a condo.
Okay.
You'd be doing conventional, not FHA. It is gonna generally, I don't know that you're really gonna be able to go down to 620 just realistically in looking at conventional. Looking at the conventional rate sheet, you get so penalized for having a score that's below 680 that I would sooner take that borrower to an FHA loan.
So if you have someone 680 or above, and you can find maybe an attached property at whatever you said around 283, I mean, we could, as realtors, we could be searching for around that 300 range. And if it's been on the market, maybe go down a little bit or tell them we're on this program. And then in this case, the buyer would only bring 1%, and then you guys would bring the other 2%, and that's a grant, right? That's not anything that has to be paid back.
Correct. And that's up to the 4,500, which technically doesn't, the math there of, so they've got this limitation of a loan amount of 275. However, if you do a reverse calculation of the $4,500 grant, that means if you want it to be 2%, it's really only working as 2% on a $225,000 loan.
So the reality is, if you wanted to go up to that maximum amount of 275, you would probably say we can still get you in for less than 3%, but it wouldn't be 1%. It would only be 4,500. Am I understanding that right?
Right. So if we did that 283,500 as being the price, then 3% of that is 8,505. So subtracting, that means they would need to come in with $4,005. Just for, and again, that's only talking about down payment. It's not including closing costs, but the closing costs should be typical, you know, like probably $6,000. They're not going to be increased by like the other down payment assistance programs, which put on an additional 1% in origination fees based on the loan amount.
So again, in order for them to really just only bring 1%, we're really looking for something you said in the 225, 230 maximum loan amount.
So 4,500 divided by 2% means a loan amount of 225. So that if I divide that, reverse calculate that to be the 97%, that means the purchase price is 200, just below 232,000.
Okay, so it might be possible for like a studio or a 1-bedroom.
Yes, I mean, it might actually have, I don't know if that would have greater, you know, in years past it did, but it's blown up so much that I don't even know if the values there would even work for this scenario.
Okay.
And so here, this is what I look at when so since I typically do CHFA, this is what I look at. I get reports on these every single day. So this is a little outdated because that's when I last created this PowerPoint, but like this CHFA preferred Freddie at 7.75 is actually 8% today. So just kind of like in general, add about a quarter of a point to all of these prices. So up here, the first two sections are conventional with Fannie and Freddie preferred. I lately just been doing Freddie because they have better interest rates. And typically also have a couple of other perks with Freddie in regards to student loan calculations that I find help my borrowers. They also have a very low income program that gets you a better rate, but it does require additional underwriting for that with CHFA. And then the bottom section is the government one. They can do FHA, VA, or RD, rural development, also standing for USDA. They have the First Step program, which also requires a second review by underwriting, which is why they've got the asterisks there. And then Smart Step, which does not require the second review. So we got the different columns of no DPA. That's that 0% that we saw on the earlier chart, if you noticed. So you can like literally just use CHFA to get a better interest rate because rates are high outside of CHFA. So they're a good program for that, because I've looked at like the buy downs for clients that sometimes, oh, I could have them do a permanent 30-year buy down, you know, with my rate sheet, my retail rate sheet, or I could take them to CHFA And it costs like half or a third of the cost for that same rate. So it's like, well, that's in the best interest of the client, taking them to CHFA. And then the PLUS grant. So there used to be, when I first was working in loans, there used to be a grant for conventional. They took those away. And now the only one that does the grant is Smart Step. The PLUS grant gives 3% of down payment assistance. It is forgiven immediately. And so there's no payment to worry about, no interest rate to worry about. You could close on this and then after 6 payments, go and refinance it. And literally that 3% of money that you got is yours to keep. And just add that to your equity. And then the last column is the PLUS second. We also call this a silent second. So it just sits there. The reasons we'll go over in some other slides as to you have to pay those back, but those have those rates. So typically you're seeing here like a 0.25% difference between no down payment assistance and getting 4% in assistance, which is what their second is 4% based on the loan amount. Or in that case, that's an 1/8 of a point difference. So, as in the client that I just worked on numbers today, he's got plenty of down payment, but I'm going to take him to CHFA because I think he can get this best rate. And also get some down payment assistance that can, help him increase his price point, and help cover the closing costs for him. So it's a really great program. So if there's no questions, I'm just going to keep moving on. The CHFA product types. So I kind of went over some of this in the last slide. No DPA. The PLUS grant is forgiven immediately. The PLUS second, also called the silent second. So it's due if you sell or refinance. It's due after 360 months or 360 payments, or even if just whenever you're done with your 30-year fixed mortgage, you're going to need to pay this one back. And it's due if you convert from a primary to an investment, for example. I don't know how they enforce that last one, but technically it's a rule, so I'm going to disclose it. It's a snapshot of like the loan limits. So this was that conventional one, the very low income one, and it's very true to its name. It's very, very low for those incomes. Boulder's the highest one in the state, obviously, at 72,000. The Smart Step program, the preferred program. So these were like a combo. The preferreds are the conventional, and the Smart Step is the combo of like FHA, VA, and USDA. Those are across the board, really simple, easy to remember. That's a pretty decent moderate income limit. And then gets a little tricky here if you decide to do the First Step program, which is FHA only. This is typically the column you need to focus on for that. They have these targeted areas that you can look up. I would typically just try to pre-approve somebody in this first column that's a non-targeted area. And then if they find a property, and they're under contract for it, go and search it, see if you can get them into the targeted one, kind of thing. But it's also based off of the number of people in your household. They give you a little allowance for that. They do have purchase price limits, but I have never run into that issue of needing to worry about those. This is from the CHFA's website about doing that homebuyer education program. So you can do an in-person or you can do it online. The in-person is, I believe, still free, generally about 6 hours, or you can do the one online. It's good for both certificates are valid for 12 months. So great education, helps explain a lot of the terms and what to expect in the home buying process. And both are about $6 in person. Oh, in person and live are free. Online portions are $75 fee per person. If you have, two people on the loan, a borrower and a co-borrower for the down payment assistance, they both have to take these classes. And as I tell borrowers, if you're gonna wait to do it till you're after contract, then do it right after you get under contract, because we've had too many issues where they weren't able to get that certificate and we're like pushing, we're not getting it clear to close. We're having to push the closing out. So, I give everybody the warning now, once they go under contract, get this done, don't leave this to the last minute, or you could be homeless. So in this market with rising inflation, high rates, and lack of housing supply, it's very difficult to save funds for down payment and closing costs. It helps home buyers jump into the market sooner, which allows them to stop throwing their funds away to rent every month and begin to build wealth with their mortgage payments, paying down the principal balance, locking in the price of a home sooner, not later and higher, gaining equity in the home as the home appreciates, improving their credit scores with mortgage history, freeing up their funds to make home improvements, and qualifying for a bigger, nicer home than without down payment assistance. And like I said, that client today that I pre-qualified was a perfect example. You know, he's got like practically you can come in with 20% down, but I feel like down payment assistance with CHAPA is going to help him actually get even more house. So other down payment assistance limitations and considerations are can't be used for second homes or investment purchases. If the down payment isn't forgiven, funds will need to be repaid. As in all the scenarios we previously talked about. Some down payment assistance programs and products require a second round of underwriting. And programs like CHAPA tack on an additional 1% fee based on the loan amount. The only exception to that list would have been the APM's 1% down program. So that is the end of my presentation of drowning you guys in down payment assistance info. So any questions?
I do not see anything in the chat box. Ryan, do you have any thoughts or questions?
Yeah, so I was kind of trying to think through some questions here because I actually literally had a meeting with a client today, and he had a meeting with a lender I want to say it was Friday, and he basically was told that his income only qualified him for $250,000. And he's trying to do like a house hack situation, preferably something like 3 bedrooms. And, you know, as you know, John, 250 where he's looking, which is up in Fort Collins area, just isn't feasible. And you had mentioned, I thought you had mentioned something about in some instances, utilizing some of these programs in order to qualify for a little more house. Can you expand on that if I understood that correctly?
Yeah, so in the scenario with well, debt to income ratio is going to be a huge determiner of how much house you can get approved for. So that's where I was kind of focusing here on this area. In that Metro DPA is restrictive with credit score, as well as the debt to income ratio. So with CHAPA, I can that 680 turns to a 620, a 660 with CHAPA. And the limits, instead of being 45 or 50, depending on your score, I can do 50 or 55 generally. So for CHAPA that I usually work with, if I've got a borrower with a 660 score, I can take them to a 55% debt to income ratio. And then if they're below the 660, then I'm limited to a 50% debt to income ratio. There's also a new thing that just hit last week that might help your particular borrower situation. I didn't prepare slides or anything because this really wasn't about down payment assistance, but it's very specific to the FHA program. And that is that they are now allowing additional dwelling unit rental income. So I don't know that it would work for just a 3-bedroom kind of situation. It does need to be a separate living unit. A separate living unit qualification by FHA standards. And they can do either a current lease on there, but if you're doing a purchase, you wouldn't necessarily be able to use like the current lease. But it could be done using a rent schedule off an appraisal. To use that income to help the borrower actually qualify for more. But yeah, that was literally rolled out like on Friday, or at least that was the first I got informed of the new guideline.
So as long as it's a separate unit, like it doesn't have to, does it have to be separate from the physical house, like a detached garage that's been redone, or can it be like kind of like what we found for Nick and Lacey, where it had a separate unit downstairs, separate staircase. Do you happen to know like what is considered a separate area?
Yeah, let me see if I can. I'm gonna stop sharing and I can show you some of the info that I did research on the topic. I put it in that email. Let me see if I can find that email. And I just kind of summarize everything in there. I think you could still do a basement. I think that has the possibility to be distinguished as an additional dwelling unit. But it does have, as you might recall on those requirements, it did require things like an egress, an ingress.
Yeah, so I just sent it to you. Let's see, we can go over it together because kind of significant here. ADU refers to a single habitable living unit, which means separate ingress and egress that meets the minimum requirements of a living unit. So I guess you have to figure that out. So ingress, I assume, means like a separate doorway to get in and a separate like egress window to get out. Private space that is subordinate in size and can be added to, created within, or detached from. Okay, so that kind of answers my question. So something like what Lacey and Nick had could work. Interesting. So how does that, I mean, I kind of glanced at this, but I didn't look at it too much, but just as a quick summary, how does that kind of change the game for certain people? It just allows them to include projected income and qualify for more so that they can then turn around and house hack?
Yeah, they can qualify, they can use their house hack to not only benefit them financially, use it to help them qualify with an FHA loan. Which is, last time I checked conventional guidelines, they don't allow for this kind of income to be used. They would still consider this person to be what they would call like a boarder, a roommate. And they wouldn't allow that kind of income to be used for, you know, qualifying, in this case, for a primary. I mean, it's a primary purchase. You can use that ADU if it qualifies as an ADU, up to, so they do have this little caveat here, can't exceed 30% of the total monthly effective income used to qualify the borrower. So I would assume that you could just, you know, tap it down and use it as much as you could to get to that point.
Can you interpret, can you kind of interpret that last point a little bit more and explain that?
So you don't want to, if you've got a borrower that's got income, effective monthly income of, let's say, $5,000, well, $5,000, you come up with the calculation of 30% of that is 1,500. You couldn't use rental income from the ADU. It couldn't exceed $1,500 because the borrower, the purchaser, if his income is 5,000, you're going to be limited to rental income of 1,500.
Okay. So it's giving you, you can go up a little bit, but not as much as the potential. You can't just tack on the potential income for the ADU, 100% of that income with 100% of the income of the buyer to then create a higher ceiling. You can only take the income of the buyer plus 30% of the projected income of the ADU. Do I have that right?
I think the only thing that I would want to dig a little deeper here, typically, when we're looking at investment purchases or rental income in general, if we're using a number that's not derived from tax returns in order to come up with a number, which is, if it's coming from tax returns, that's usually involving someone's buying something else and we're trying to offset those mortgage expenses, or they're refinancing that particular property, the subject property, and they already have a lease on it and they've got history, and we use tax returns to create the rental income number. But typically, if we don't have tax returns, and in this situation, we wouldn't have tax returns, typically we're only using 75%. So I don't know that we can use 100% of the rental income. I would imagine that there might be a limitation in only using 75% of that income, like we would in other scenarios. But if it is 100%, that would be fantastic. But typically we only use 75 to allow 25 for vacancies and maintenance.
Okay. So once again, it'll be one of those things, if we run into that scenario, you can calculate it, but at least now it looks like we could raise the ceiling of what somebody could qualify for if it has a legitimate ADU.
Yes, for FHA. So, as I was explaining to our client today, he's possibly interested in something like this, but I explained to him it would be no longer considering a conventional loan. We would have to rerun numbers with FHA, which would generally also likely end up in being an increase in what he qualifies for, just because the threshold for conventional is typically a 50% DTI, and with FHA it would be 55, as long as you have excellent credit.
So in this individual's case, if I could find something with an ADU, then that might increase the ceiling that you mentioned to me earlier today.
Yes, that would be yeah.
And that would be good if you have a chance to do that, because there is one in Longmont that has an ADU that I think would, but I don't know if it would bring it up enough. So when you have a chance, let me know what that number might look like.
For that client in particular,
Yeah.
yeah, I would need to rerun all the numbers for that.
Okay. I mean, not essential right now, but it would be interesting to know, because this particular person is looking to house hack, and there is one in Longmont that I sent to somebody else already that does have that separate ADU.
Very nice. Brian, do you have any questions about the down payment or the ADUs that I can answer before I move on?
No, I was just kind of thinking through kind of the same situation. I have a client that wants to house hack, but like I said, he's got that 250K limit, and I'm just kind of trying to think how that would be able to help him.
Yeah.
Because his issue isn't so much DTI. From what I understand, he has a very high credit score, and I think he said no debt. It's just I guess his income just is limiting him on what he qualifies for. So just trying to find some kind of solution for him.
Yeah. Yeah, that could be it. He would just have to switch over to FHA. Understand there's going to be mortgage insurance, involved with that,
Mhm.
but it's the FHA mortgage insurance rates that we were dealing with, 2 years ago. They've had that reduction,
Yeah.
earlier, so could be worth it. Definitely be worth it. Well, our next meeting is not 10/24. I didn't update this yet. So our next meeting is actually going to be scheduled for November 14th. So it's in 3 weeks. November 14th. Amber is going to be our insurance specialist is going to be the presenter. And she's gonna be doing a topic on Legal Shield, which is the landlord's must-have. So she is licensed to also sell Legal Shield, and she has some horror stories to tell us of her use of Legal Shield, how it's helped her as a landlord herself. I'm sure it's probably helped in creating some of those leases for her, as well as the issues that come up in some RCP on Meetup. To this, I'll be posting it tomorrow. And you can follow and chat with us during the week on our Facebook group at this Facebook address, or you can subscribe to our YouTube channel and rewatch today's meeting if there's, something that comes up and you want to get all those juicy details of all the down payment assistance programs that we have here in Colorado available to us, because CHFA isn't for everybody. And maybe you want to go back and review that. So thank you guys so much for coming.
Good job, Genevieve. Thank you. Great, very helpful information.
Any last questions I can help with?
No, I appreciate your time though. Thank you so much.
Awesome. Thank you so much for joining us, Ryan. And we look forward to hopefully being able to see you again, or please feel free to reach out to me if you have any questions that I can help you with and follow up.
Yeah, definitely. I might wind up sending him your way and see if there's something that we can figure out for him. Just see if we can get something figured out for him, because he's considering moving out of state if he can't figure something out. So
yeah, Genevieve is one person that I've been very impressed with. Again, I work with a few lenders as far as just finding ways, overturning every rock, being a bulldog, working with underwriters, arguing with our underwriters. She's been great. So if there's somebody can make it happen, it would be her.
Yeah, and that's the thing. Like, I feel like I like to send clients to multiple different people, because in his particular situation, it feels like not all the rocks were over, turned over. So like I said, I'd like to maybe send him your way as well, and see if we can't figure out something for him.
Wonderful. Ryan, do you mind do you have access to our chat box?
Yes.
Would you mind putting your email in there, and I can shoot you an email with my contact info?
Yeah, I actually wound up scanning your Hi Hello. I use Hi Hello as well, and it did a live connect. I don't know if you got that come through, but I have all your. Did you get that?
I put my phone on mute so that we wouldn't have any interruptions. So.
Oh no, you're fine. I did it when you had the screen up though, and it just came through on my phone saying that that we're on there. But let me double check.
And also, thanks for sending me the thing on the market podcast, because
Oh yeah, on the market.
It's very interesting.
Yeah, no, they're really good. They always have some really interesting people on, and they always cover some really great topics. It's if I understand it correctly, they're affiliated with Bigger Pockets.
Yeah, I'm gonna shoot you something really quick, or I'm gonna put it right now. Yeah, on where is that?
I was gonna say, I'll put my email in here real quick, in case you didn't get that, Genevieve.
I'm looking at my inbox. It's telling me that I have a sharing from Ryan. So
there we go. Yeah, of course.
And the link that I just sent, you guys might find interesting. It's all about someone who wrote a book. She's a realtor in Colorado, and she did a podcast for Furnish Finder, because that's their niche, is doing midterm rentals. And this really gets kind of she previews her book and gives a lot of tips. I found it to be very helpful. And for those, Ryan, for your buyers that are looking for midterm, and then the big question is how to manage it. Like Jen and I have a client that he bought a midterm furnished rental in Windsor, and there's still a lot of kinks to work out as far as getting things right, what platform to put it on,
Mm-hmm.
how do you change the pricing here and there. So you might find that that podcast to be interesting.
Yeah, definitely. The Landlord Diaries, is that what it is?
Yep.
Okay.
Yep, it's from, I don't know if you've heard of Furnished Finders, but they're kind of like an Airbnb. The fees are a lot lower, but
Mhm.
they're more like a matchmaker. You just pay a certain amount every year to have your property on there, and then
Yeah.
they try to bring people together. And then after that, you create a regular lease like you would normally in a 1-year lease. But a lot of traveling nurses and digital nomads like to use that site.
Yeah. Okay, cool. Appreciate that.
Hmm. All right. Well, thank you, Genevieve. I'm going to go ahead and sign off. Ryan, it was nice to meet you. I'm sure we'll run into each other at some point, and you guys have a good evening.
Yeah, definitely. I'll reach out to you, Genevieve.
Sounds great, Ryan. Talk to you
All
soon,
right.
John.
Have a great
Bye.
night, guys.